Compared to the rest of the world, the United States homeowners have more fixed rate debt, whereas many other homeowners in other parts of the world have more variable rate debt, or debt that stays fixed for kind of a shorter period of time and then becomes more variable. In addition, our corporations also locked in a lot of long duration fixed rate debt. More so than the average corporation in other markets. And so the result of that is that as the Fed raised rates, it wasn't particularly kind of impactful for the majority of homeowners or corporations. Where it was impactful is generally smaller parts of the market, like small business, kind of like loans from banks that are more short duration, or commercial real estate's obviously been kind of a train wreck. And in general, junk rated, corporate bonds that, shorter duration, therefore get refinanced more regularly. But those are generally smaller markets than those other kind of core types of debt. And then ironically, the U.S. federal government has not that very long average duration. It's something like 6 years. But even that's kind of front loaded because, you go from very short duration T-bills all the way up to 30 years. And so the fact that the average is like 6, realistically, a lot of it's in that first 2 years. And so as they hiked rates and then held them pretty high, a lot of that debt refinanced to higher rates, which means bigger interest expense and therefore bigger deficits, which ironically are kind of stimulatory on the economy, which offsets some of the hiking we've seen on the private sector. So overall, the U.S. was fairly resistant to rate hikes compared to the rest of the world. Now, back in 2022, I thought that they'd probably run into frictions sooner than they did. But it was by, say, early 2023, I started to realize that this duration mismatch is having quite a big effect, bigger and quicker than I would have guessed. And so I had to pivot my view toward that that fiscal dominance theme and kind of reiterate that. And we're still largely in that regime right now. And one thing I raised in my recent newsletter is that we're probably going to see a similar phenomenon on the other side of this, which is that if the Fed mildly cuts rates, it's not potentially going to be very stimulatory because not that many people locked in debts at these higher rates that are worth refinancing.
Did you know that the average duration of US federal debt is just 6 years? As Lyn Alden explains, this short duration means rate cuts might not stimulate the economy as expected, potentially leading to a recession instead. When rates are cut, not many homeowners or corporations have high-rate debt worth refinancing, which limits the economic boost we might expect. This unique scenario could have significant implications for both the housing market and corporate debt landscape, especially since most US homeowners and corporations have already locked in lower rates. With fiscal policies running massive deficits, the US could face a recession in real terms, even if nominal numbers stay strong. Lyn Alden highlights how the divergence between fiscal and monetary policies could weaken consumer spending and impact various economic sectors, especially those reliant on short-term debt. As rate cuts fail to stimulate the economy, the strain on consumers and businesses could become more pronounced.
Basically, the last 40 years of U.S. financial history can be characterized by lower lows and lower highs of interest rates, including long duration rates like mortgages. This was the first cycle where we got a higher high in both short duration and long duration interest rates. And I think there's a good chance we're going to get a higher low in terms of interest rates, which kind of limits how much refinancing is out there. There's not going to be a lot of homeowners ready to jump in and refinance. Only the fairly small percentage that actually took out rates, mortgages at these fairly high levels, which is obviously a decreased number because those rates are so high. And same thing for corporate debt. And so while it will impact some of those more rate sensitive areas of the economy, I think the market is overall over kind of indexing the importance of fairly small amounts of rate cuts or rate hikes or when they're going to happen. And I think a far bigger variable to focus on is fiscal policy, which is not controlled by the Fed, but rather controlled by the Congress and the president. So I think that's part of it. Staying high enough is starting to impact the private sector a little bit more with each quarter that goes by, especially the weaker side. So consumers that don't own assets and didn't lock in mortgage rates, and maybe even have credit card debt with variable rates and things like that. Ongoing slow motion implosion in the commercial real estate sector. Those types of impacts. We're starting to see softening in the labor market. So unemployment rate jumps from 3.4% to 3.4% to 4.1%. We see an uptick in continuing claims, which is a fairly fast turnover indicator that we can check. And retail spending came in a little bit hot recently, but it's still actually not really hot in the grand scheme of things. It just beat weak estimates. And so I think we're kind of seeing somewhat of a rotation. Basically, during and shortly after the lockdowns, when people couldn't travel and no one was really going out or anything, they loaded up on home purchases, consumer durables, goods, even homes and modifications to homes themselves. Then when things did open more, people rotated into travel and restaurants and things like that. There's kind of that pent up demand. It's okay. We got our consumer durables figured out. We bought all the stuff we want when we were locked at home, and now we're going to go travel and eat out and stuff. So we saw that rotation where the consumer was really leading things. And if anything, we've had a mild manufacturing recession for a year and a half. Commercial real estate's in a depression. So there's weak areas of the economy, but then there's those stronger consumer side. And the consumer side has been reinforced by some of those interest expenses. But when you look at, for example, the higher income people, a lot of them locked in, fixed rate mortgages. They have money markets. So every time the Fed hiked rates, they get more income. They're on the receiving side in some cases of Social Security. And just overall, their assets are doing quite well. Stock market's up. And so there's been a fairly significant amount of consumer spending on especially the higher end of the income spectrum. And I think what the data start to show is that is softening a little bit. It's still positive, but it's softening. Meanwhile, we probably are seeing somewhat of a bottom in manufacturing activity. So it's not like people often think is a recession or no recession. Like, are we going into one? Whereas when you have fiscal and monetary policy differ by as wide of a margin as they currently do, which is a bigger than normal margin, basically to be running like 6% of GDP deficits, while also holding interest rates over 5% and shrinking your Fed balance sheet. These are two very divergent policies going on, and so sectors that are on the right side or the wrong side of either fiscal deficits or short duration debt, they're going to be impacted very differently. And I do think we are starting to see a little bit of, or at least early signs of a rotation, that maybe the consumer is starting to get a little weaker around the margins. The payroll data is a little softer, whereas some of the other data was already weak, and if anything, is maybe firming up from those weak levels. But that would be one way to make it happen. If they basically said, okay, we're going to do a massive tax hike and we're going to trim these spending areas, that would kind of alleviate the fiscal side, and we probably would enter at least a very soft period, if not an outright recession, depending on how big those are. Given that fiscal backdrop, it is harder to enter a recession, but it's also harder to get CPI down to 2%. And one way to look at this is, you can look at historical periods, but you can also look at emerging markets in the modern day, which gives you a more extreme example, where recessions often look different in emerging markets. Sometimes they're even still growing, and they're still kind of inflationary. It's in real terms where the struggle shows up. So if you kind of see what those economies are doing in dollar terms, that's when they start to not look great. And so I think in the United States, basically where a recession could happen or where a soft patch could happen is in real terms, which is to say that maybe the nominal numbers keep running on the hotter side because of the ongoing, large deficits, fiscal dominance. But if that does translate into, an uptick in energy prices, or just an ongoing inability to afford homes for people that didn't lock in a home before all of this happened, the people's kind of both real and perceived quality of living can be very much struggling in those real terms. And so you could have a situation where maybe unemployment goes to 5%, for example, and maybe we do on a real basis look somewhat recessionary, at least in enough categories to matter, while other areas could still be running hot and where nominal GDP could still be somewhat decent.